Imagine a balloon being inflated. Air goes in, the balloon gets bigger. That's like a housing market. Demand pushes prices up. Now keep blowing. What happens? The balloon bursts. That's a bubble. Prices are too high, demand can't keep up, and bang, the market crashes. In a housing bubble, people rush to buy, thinking prices will always go up. They take on big mortgages they can barely afford. The danger is when interest rates rise, or demand falls, prices stagnate or drop. Suddenly, those mortgages are ticking time bombs. Remember 2008? The housing bubble burst, and the world felt it. People lost homes, jobs vanished, and the economy took a nosedive. That's the scary reality of a bubble. It's not just about houses, it impacts everyone. We need to learn from history. Recognizing a bubble is crucial. Understanding the risks can help us make smart decisions and protect ourselves. Remember the balloon? When it pops, the air doesn't just disappear quietly, it causes a stir. A housing bubble burst is similar. The impact ripples through the economy, touching everything. First, the construction industry takes a hit. New projects stall as demand for houses plummets. Jobs are lost, impacting spending and slowing economic growth. Next comes the banks. Remember those risky mortgages? People default, banks lose money, and lending tightens. This makes it harder for businesses and individuals to get loans, further stifling the economy. The stock market reacts too. Uncertainty makes investors nervous. They sell stocks, prices drop, and people lose savings. Fear and panic can grip the market, amplifying the downturn. A housing bubble burst isn't just about houses. It's a systemic shock. It exposes the interconnectedness of our economy and highlights the importance of a healthy, stable housing market. Remember, Rich Dad teaches us to be aware. Is the housing market whispering bubble today? It's like a game of Clue. Look for the signs. Rapid price increases. Are housing prices rising faster than wages and inflation? This could be a red flag. Sustainable growth is key, not overnight surges. FOMO, fear of missing out. Are people buying in a frenzy, afraid of being priced out? Emotional decisions driven by fear are rarely sound investments. Loose lending practices. Are banks offering risky mortgages with low down payments and flexible terms? Easy money often leads to reckless borrowing. Overbuilding and speculation? Are developers building more houses than the market needs? Speculators buying and flipping properties quickly? These are signs of an overheated market. No single sign guarantees a bubble, but if you see several, be cautious. Don't be afraid to ask tough questions. Is this real demand or speculative frenzy? Rich Dad says, don't put all your eggs in one basket. This applies to real estate too. Diversification is your shield against market volatility. Imagine you invest all your money in one property and the local market crashes. You're in trouble. But if you diversify, you spread the risk. Geographic diversification. Don't just invest in your backyard. Explore different cities, states, or even countries. Each market has its cycle, so spreading your investments reduces risk. Property type diversification. Don't limit yourself to residential properties. Explore commercial real estate, rental properties, or even land. Different asset classes perform differently in market fluctuations. Investment strategy diversification. Explore options like REITs or real estate investment trusts or crowdfunding platforms. These offer exposure to real estate without direct property ownership. Diversification doesn't guarantee profits, but it cushions your portfolio from market shocks. It's about spreading your risk and creating a more resilient investment strategy. In the game of real estate, knowledge is your ace. Don't be swayed by hype or emotional appeals. Do your homework. Understand the market. Research the local economy, job market, population growth, and infrastructure projects. These factors influence property values and rental demand. Analyze property values. Compare prices of similar properties in the area. Look at historical trends and future projections to assess if a property is overpriced or undervalued. Inspect thoroughly. Don't skip due diligence. Hire inspectors to assess the property's condition. Unforeseen repairs can derail your profits. Review rental history. If you're buying a rental property, analyze past rental income and expenses. Understand vacancy rates and potential tenant issues. Knowledge empowers you to make informed decisions. Don't be afraid to ask questions, seek expert advice, and trust your gut. Remember, investing is a marathon, not a sprint. Real estate isn't about getting rich quick, it's a long-term game. Patience and perspective are your allies. Ride out the fluctuations. Markets go up and down. Don't panic sell when prices dip. If you've invested in solid properties, hold on. Time often corrects market imbalances. Focus on cash flow. Look for properties that generate positive cash flow. Rental income should cover expenses like mortgage payments, property taxes, and maintenance. Build equity gradually. As you pay down your mortgage and property values appreciate, you build equity. This is long-term wealth creation in action. Enjoy tax advantages. Real estate offers tax benefits like deductions for mortgage interest, property taxes, and depreciation. These advantages can boost your returns. Remember, real estate is a marathon, not a sprint. Stay focused on your long-term goals, be patient, and ride out the market's ups and downs. Even with careful planning, real estate investing has risks. Smart investors anticipate and mitigate these risks. Cash reserves. Don't over-leverage yourself. Have enough cash on hand to cover unexpected expenses like repairs, vacancies, or interest rate hikes. Insurance coverage. Protect your investment with comprehensive insurance. Property insurance, liability coverage, and even landlord insurance are crucial. Exit strategy. Have a plan for every scenario. What if you need to sell quickly? What if the rental market softens? Knowing your options helps you navigate challenges. Professional guidance. Don't be afraid to seek expert advice. Real estate agents, attorneys, and financial advisors can provide valuable insights and guidance. Risk management isn't about being pessimistic. It's about being prepared. By anticipating challenges and having contingency plans, you can weather market storms and protect your investments. Remember, knowledge is power. The more you understand about real estate and the economy, the better equipped you are to make smart, informed decisions. So keep learning, stay informed, and never stop investing in your financial education. Your future financial freedom depends on it. Please like and subscribe.